The longest running bull market in history, that ran from 2009 to early 2020, came to an abrupt end as COVID-19 rampaged through the world. Since then, we've seen a resurgence in both equity and bond markets on hopes that the massive government stimulus would lead to a global economic recovery. What are some of the investment opportunities and challenges in this post-COVID world? And how should investors position their portfolios to be more resilient in these uncertain times? We speak to Citi strategists on their outlook for the second half of 2020. Ken, as countries around the world slowly emerge from their COVID-19 lockdown, do you see that resulting in an upturn in the global economy growth?
Well, yes. Thanks to the coronavirus, we just gone through the deepest, but also the shortest recession in history. Now, reopening and recovery is spreading across the world. Here in Asia, in this region, we're a little bit ahead of the crowd. Take a look at China, for example. Back in March, we already started recovering. Since then, we've had a sharp rebound in retail sales, industrial production. The US is a little bit behind, but reopening over there is progressing slowly but surely. Policymakers have had a huge hand in this recovery. The Fed has expanded its balance sheet by $3 trillion over a 2-month period. Now, last time, after the global financial crisis, it took them 5 years to do the same. And with that kind of unprecedented policy, we're seeing a very unusual recovery as well. Well, as with any business cycle, there are risks. We see 2 key ones here. First is the potential relapse of this virus. The second is the relationship between the US and China.
Equity markets fell sharply in March this year, probably the lowest they've been since 2016. But then we saw a resurgence of up 32% to the end of May. Does that mean that the worst is behind us? And where do you see some of the opportunities in this space?
Well, yeah, thanks to the stimulus, the equity market has rebounded substantially since the March lows. We don't think we're going to be revisiting those lows. We believe that, first of all, small and medium cap companies, particularly in the US, likely to outperform large cap companies because that happens every business cycle at the beginning. We don't think this is going to be all that different. The second group is emerging markets. A lot of EM stocks have been battered because of the crisis. But now, because the dollar liquidity has been replenished, we think they have an opportunity to recover. We think LATAM has a lot of markets like this, but closer to our hearts, we still like Asian EM. Stay focused on the longer term prize. That is what we call unstoppable trends. These include technology, right? These are your 5G ideas, your internet, e-commerce. These are cybersecurity, fintech. We think these areas will continue to see significant growth. Healthcare is another area that is likely to see sustained high growth in terms of demand and also taking advantage of technological advancements.
Lena, in response to COVID-19 pandemic, the central banks around the world implemented strategies such as quantitative easing and negative interest rates. What's Citi's view on these policy actions going forward?
Interest rates across developed markets are close to zero and may stay there for some time. While central banks have responded aggressively to the economic impact caused by COVID-19, further actions will not be surprising. Citi expects that Fed will keep rates low at the zero lower bound level. The Fed is unlikely to raise rates unless they see unemployment rates drop drastically. Citi also expects $6 trillion in global quantitative easing over the next 12 months, which is 3 times its peak.
Lena, the fixed income market came under a lot of pressure during March due to the COVID-19 uncertainty. Having said that, the severe dislocation we saw early in the year has largely been resolved. Where do you see some opportunities in the market for investors to find yield?
We express caution, as the pandemic will likely result in one of the deepest economic contractions in modern times. We maintain a high conviction on US investment-grade bonds, where we see best relative value in the 5 to 7-year tenor to maturity. In emerging markets, we have a high conviction on US dollar bonds. To be clear, the outlook on emerging market fundamentals has worsened. Deficits are wider, growth is slower, and central banks may run out of ammunition. However, valuations are cheap, as these risks have largely been priced in. Citi analysts favor diversification, with Asia and Latin America looking attractive.
Jay, the US dollar has been under a lot of pressure since the Fed's cut interest rate to zero and had an aggressive liquidity injection of US dollars into the economy. What's Citi's stance on the US dollar going forward, and what's our outlook for safe haven currencies?
There has been an unprecedented demand for dollar liquidity globally following the pandemic, and that resulted in a dollar spike that we saw during mid-March. Since then, the Federal Reserve has stepped in to adequately address the dollar liquidity issues by aggressive monetary stimulus, and dollar sentiment has reversed as a result. Now, risk aversion can come back, but any rebound in the dollar as a result is likely to be limited. When we talk about safe haven currencies like the Japanese yen, Swiss franc, and gold, and on the other side, risk-on currencies like commodity FX, the Australian dollar, the New Zealand dollar, the Canadian dollar, and Asian emerging market currencies, the primary driver is risk sentiment. Now, looking ahead, risk sentiment is going to be fairly brittle. Investor sentiment is going to be short-term focused, driven by news flow, and investors need to be nimble. Gold is perhaps the one safe haven entity that's been resilient through both risk-on and risk-off periods, and that is likely to continue. Gold tends to perform well also during periods of ultra-low and even negative interest rates that we are seeing throughout the G10.
Jay, what are some of the other opportunities in FX?
The medium to longer term opportunities lie in the euro and sterling that are likely to see a more sustained rally over time, albeit grinding. And this comes about as policymakers from both sides now make a commitment to deliver a more well-coordinated monetary fiscal response to the COVID-19 crisis. The one headwind are the Brexit talks, which are currently deadlocked. But the bar towards a no-deal exit by the UK is very high.
We hope you found these insights useful. Please stay safe and healthy during this period, and contact your Citi Gold Relationship Manager for more information.